Okay, that is 2 o'clock. And so let's go ahead and get started. Good afternoon, everyone. We have about 20, 30 people in the room so far, but I know that's going to quickly change here, Jim. So we'll do some intros, and by the time we're done, I'm sure we'll have a room full because I know we had a couple of hundred people registered. So we'll let those folks file in. But good afternoon, everyone that's with us right now, and thank you for joining us on today's call. And welcome to our latest Industry Insights webinar: 5 critical steps to improve profitability in 2022 and beyond. Today's webinar is hosted by obviously Loan Vision and Teraverde, and we also have some very special guests that I will be introducing here momentarily. To Veritable Rogues Gallery there, Jim. Thank you for that. For those of you that don't know who I am, my name is Carl Wolloff. I'm the Director of Sales and Marketing here at Loan Vision, and I'm going to be comparing or hosting this session for the next hour or so. But before we dive into kind of intros and today's content, I do want to touch on a couple of housekeeping items. Firstly, we are indeed recording today's session. So if you do have to jump for some reason, don't panic. We will be sending out the recording in the next day or so, once it's downloaded from Zoom and available to us. So keep an eye out on your inboxes for that. Secondly, we have everyone on mute because obviously to stop background noise and things like that, but we do absolutely want this to be an interactive session. So if you do have any questions, please go ahead and send them to us via the Q&A box. There is 2 ways to talk to us. There's a Q&A box and there's a chat box. Q&A is definitely the best for questions, okay? So make sure you click on the Q&A, type in your question, and we will get around to addressing it as we kind of move through the session here. If we don't quite understand the question, we can put people live and things if we need to. We'll worry about that should that happen. So keep the questions coming over, keep them and try and pop them in the Q&A box if you can. Okay, well, perfect. Now that we've got kind of housekeeping out of the way, let's go ahead and get started by introducing you to our panel. Joining me on the Loan Vision side will be Martin Kerr, running a couple of minutes late, but he'll be here shortly. I know most of the people on the call know who we are, and you will hear us chime in from time to time. But most importantly, let me introduce you to the 3 fine gentlemen staring at you from the screen here. Let me start with Bob, or Robert Perotti, I should say. Rob is the CFO of Homestead Financial Mortgage. Bob is a CPA and has held the position of Chief Financial Officer at Homestead for the past 6 years. Previously served 25 years in public accounting before moving into the CFO position. And Robert, or Bob, as I know him, Bob, I don't know what you prefer. I'm going to go with Bob.
Bob's just fine, Carl.
Bob spearheaded the transformation of Homestead Financial Mortgage from a 99% consumer direct model in 2015 to a 40% referral model in 2021. Who funded 830 million in 2021. So Bob, thanks for joining us. We also have on the call here, we have David Fitzell, SVP Director of Residential Lending. I keep wanting to say mortgage lending, residential lending at Meridian Bank. As Director of Meridian Bank Residential Lending Division, David Fitzell has led for the last 20 years a dynamic team of experienced banking professionals focused on all aspects of lending. His economic-driven approach features a balance between value creation and risk management. David previously served in his local community as a fireman in the Baltimore County Volunteer Fire Department, including serving as captain, chair of the finance committee, and board member. David, thank you also for joining us. And then last, but by no means least, we have Jim Deitch, co-founder and CEO of Teraverde. Again, I find it hard to believe that anyone on this call doesn't know who Jim is, but just in case, I will read your bio, Jim. Jim, co-founder of Teraverde, after serving as CEO of 5 federally chartered banks for over 25 years. Teraverde advises over 200 clients in mortgage banking, capital markets, and financial technology, ranging from the largest U.S. financial institutions to independent mortgage bankers. He has served on the MBA Residential Board of Governors and CEO panelists and speakers from major financial institutions, financial industry associations, corporate clients, the Department of Defense, and several universities. Jim is a thought leader and has published 3 best-selling books, including Strategically Transforming the Mortgage Banking Industry. Jim, I'll speak from experience, probably one of the smartest people I've ever met. So honored to give that introduction. So with that, I'm going to kind of duck out. I'll be kind of fielding questions as we go through. Please don't forget to pop them into the Q&A box as they come up. With that, Jim, I'm going to let you take the reins.
Carl, thank you very much. And David, Bob, thank you so much for joining us. I think this is a forecast many of you have seen. It's from Mike Frattoni at the MBA. And his sense is the market is going to be contracting down 35%. No news here. But one of the things that I've done in terms of writing books and talking to a lot of different CEOs, COOs, and other C-level people is just say, so what do you think of all this? And I have 3 different reactions here, and we're going to tee this up as the basis for our conversation. So the first is we're moving quickly to take some critical steps to improve profitability. So that's a consistent top performing mortgage banker, a CEO in which I talk to quite frequently for ideas. Another is a publicly traded CEO that said, hey, we're focused on strategic priorities while seizing market share from competitors that are less capable. So that's another approach. And lastly, kind of the hope and a prayer approach is, gee, I just hope this doesn't get so bad we give too much back. So the implied strategies here of the first CEO and really groups of executives is a proactive speed to adapt to what's a rapidly changing environment. The middle is kind of volume's always the answer, and the bottom is hope and wait and see. So we're going to focus today on the idea that there are 5 things that you could do to really enhance profitability 2022 and beyond by adapting your strategic plan to some of the realities that we have with us right now. Interestingly, the second strategy, volume is the answer, is a publicly traded company that just reported their profitability is down 97%. And their stock is down 87%. So I don't know that volume is always the answer for this group, but I do know that planting the seeds of strategic adaptation is there. And that's why I'm very honored to have Bob and David, very capable executives who have already begun to take in some of the steps that we're going to talk about today. And really this discussion is adapted from discussions with Bob and David on this very topic. So these are the 5 topics we're going to cover, and we're going to start with really creating a strategic adaptation business plan. It's not a strategic plan per se. It's saying a lot has changed in the last 45, 60 days, so what are we going to do? And it starts with accepting that companies cannot likely maintain their volume. If you're down $1.5 trillion, someone is not going to make it up on share. And knowing your profitable volume levels, not just volume, but where is the break-even point? How are you going to really focus on running your business so that you're profitable at all times? And continuously trade up people, processes, and systems and protect your profit, equity, and liquidity. So gentlemen, panelists, just maybe kick it off, either one of you on some thoughts.
I can jump in real quick. We actually probably started this process back in June or July. All of us could read the writing on the wall that volumes were going to be at some point pulling back. And at that time, I would say we were we're in the infancy of using metrics, and we have our high level ones that have been very tried and true over the years. But at that time, we decided to have our management group show up to their weekly meetings with their big 3 metrics, and start to get that process rolling so that when it happens right now, volumes have shrunk, margins are tightening. We've already put in place the wheels to be able to adjust quickly and maintain our our profit levels, be well above break even, understanding break even. And that's a big part of what we look at on a daily basis.
David?
I agree, Jim. Primarily, we always are monitoring our pipelines and market conditions, and kind of doing some economic forecasting to see where we think the market's going to land. As we've talked about in our team, we were coming from basically the best of times into a new time, and we needed to be able to shift into that new environment and remain relevant. And I think we've positioned ourselves well for that. We feel like 2019 looks a lot like 2022, where it's going to be kind of a difficult first quarter, but as the year progresses, I think it's actually going to be a pretty good year for mortgage banking if you're paying attention to the details.
That's really interesting. Rates certainly have risen, and in talking with both of you in our warm-up session yesterday, what came across to me was a sense of optimism that yes, there's some challenges, but there's really a lot of opportunities to manage through this. And that really is the basis of the webinar today. David, we've had some discussions about setting minimum production standards for people, volume margin. But before we get into that, you have a way of setting up how you really start with your required profitability and then build up from that. Do you mind just sharing a little bit of that philosophy?
Sure. So, the way that we've approached things in the past or every day ultimately is that we say, okay, this is a fair amount of money that we need to ultimately make for the organization. And then we backload into that is primarily how we do that. And then we try to set our rate structure around a model that's going to win the day when it comes to pricing. Right now, we're seeing, a lot of mortgage companies react, a lot of banks react by compressing margins quite greatly. We're pretty much staying true to our model and know that ultimately it's not going to lead to profitability for them. And so it's kind of short-sighted in their part. If they would just play their normal game or set their model so that they back into a certain profitability metric, they would ultimately have a more stable environment and keep their team together, which is what our focus has always been.
So David, if I hear that correctly, you're starting with the bottom line, saying this is the profitability we're willing to accept. You've kept your costs from our relationship over the last couple of years. I know you've kept your costs really, really under control, and that provides a fairly sharp pencil in terms of going to market with the price of the consumer. But you're really varying. You're willing to let volume float based upon the profitability in your cost structure, and that's, I think, different from a lot of people. Is that fair?
Yeah, that's a fair statement. Ultimately, our salaries and cost metrics adjust with the market conditions is how we backed into that. And it's been a formula that we've used for a long time. So ultimately, you'll see some peaks and valleys, with volume. But as long as you're keeping, the accountability there with the metrics, the model basically self-adjusts so that we stay relevant.
Yeah, one of the things that we've spoken about is those 5 key factors, and I'll just kind of run through these for our audience. The idea is it's not volume, it's really the 5 key elements here. It's volume, margin, turn time, cures, pull through, and then ranking the team from the very most productive, number 1, down through all of the units to the bottom of the stack. And in doing so, David, I don't want to put any words in your mouth, but your sense is you have to hit these minimum standards or you can't be part of the team. Is that a fair statement?
Yeah, absolutely. We're always looking to trade up with our team, and if somebody's not, holding certain minimum margins, minimum metrics, we ultimately can't afford to keep them because it's not accretive to the bottom line. It's hard as mortgage bankers to give up volume, but when you actually study the granular details, it ultimately translates into they're not actually adding value to the organization. And so therefore, we've got to make room for people that can.
Awesome. And another item, and this is something that I really want to thank you for helping us develop in the Cohias platform, the margin dashboard. And this is how you really evaluate both the forward pipeline as well as the prior performance. Do you want to comment? Do you want me to run it and let you walk through it? What's your preference?
Yeah, sure. If you want to run through it, I'm happy to explain how I use the tool and how we built it. ultimately, I look at all of these different metrics. I start my morning with this screen, which pretty much tells us how our organization's doing. And I look at this as our early warning indicator to see how, active pipelines growing or declining, are our margin metrics being held. Anytime rates run, we expect margin compression is kind of, normal to see margin compression, but we want to make sure we're always focused on these things. And then the funded pipeline. So with this system, we're able to go in and actually rank our team in real time and make proactive management decisions. And we've also, with the cost and cures, data that we can pull out of this, we've been able to actually focus on those things and get a lift in our profitability of 20 basis points. The data that's being shown here is not our data, as we're a publicly traded company, but it pretty much tells the story of what we'd expect this year with that margin on that last screen being in red. What that's saying is that your month-over-month trend is declining. And what I look at is things that turn red or yellow to say, okay, do I need to look here? And if it's something I would expect, that's fine. But we've also found some pricing errors with investors and different things of that nature that have popped up that have allowed us to go back and fix things before they occur on the back end. It's really neat to be able to, slice and dice this monthly, weekly, yearly, and then ultimately be able to rank the team in real time. It's also good to have the data because it allows us to keep the team accountable to meeting these metrics versus, the paper spreadsheets we used to use and so forth.
Yeah, so you're really using this historically to look at kind of the rolling 13 months on those 5 keys, and then also what's happening like real time with respect to the margins at the producer level, whether the direct to consumer or retail. So appreciate it.
Yep.
So Bob, any thoughts on, you have a slightly different model, and I know that you've had some thoughts on how you're managing your producers.
We do. We manage them. We've managed them in the past, mostly through the Loan Vision product. We are now, and I think, do you have a next slide up, queued up? Our conversion model. So in the past, we had to pull this data from Encompass, which was a little bit time consuming. But our conversion percentages have remained very consistent over many, many years, that from the file started to the disclosure, from the disclosure to the scrub, and then from the scrub to our funding. So we would be 60, 70, 80%, although this isn't our data. But from our perspective, we jump into this panel probably daily as well. We tend to do a 60-day look back and a 30-day window on it, so that we can make sure that we are converting at these measurements. And then from there, when we actually got this panel, it was we had an opportunity to go into where it says detailed discovery, and the panel provided us with a scattergram, and we had not, and again, I would say we were not very good, just being transparent, we were not very good at the detail metrics. And that's what's happening with us in 2022. Our mission is to be very, very good at the metrics. But when we had the opportunity to get this panel and then get to the scattergram, our 2 best performing loan officers were, and again, we convert from started file to disclosures 60%. Our 2 best performing loan officers were at 30%. So from our perspective, we were like, we need to understand what we're missing here, what they're missing. Why are they not performing at the level where the rest of the grouping is? If you're looking at a scattergram and you're at 60%, that group is at that 60% level, the bulk of them. And we had these 3 or 4 outliers. One individual was way above there, and then these 2 high performing ones were well below. So from our perspective, we're using tools, the tools in Coeus to really understand and dive down and be able to modify behavior so that, we necessarily in this environment, we don't necessarily have to do a whole lot differently. We just need to affect a little bit of change in conversions and pull through, and we can stay well above break even.
And Bob, in knowing what the pull through and conversions are going to be, that's really a proxy of how you estimate break even.
Oh, absolutely. Yeah, I can use this tool. I know that 80% of what we scrub, we fund. And from that perspective, I know I don't even have to do a financial statement for the next month because I know where our gross profit is. And, I can just do the math and bam, I'm pretty much right on the number. So I love it for a forecasting tool using the conversion metrics piece with our organization.
And knowing this is, for anything you're seeing today, to our ladies and gentlemen in the audience, this is all anonymized data.
Yeah.
It's real loan data, but it's anonymized in a way in which the examples are using real data, but the confidentiality is maintained.
Yeah.
What we did just a minute ago was to focus on that lower left-hand side of that profitability quadrant to get into the individuals with lower conversions. So this is a way to say that loans are coming in, but they're not necessarily funding, and you can focus and see where those conversion percentages happen to be. And again, Bob, thank you so much for kind of helping us think about this, because most of the ideas, virtually all of the ideas that we're talking about today literally come from talking with executives in the business.
Yeah.
Another idea that's come through is to do that same approach for underwriters, processors, closers, to look at how fast and how quickly things are kind of flowing through the system. So one way to do that is to say, show me just the purchase units, show me really how the underwriters are moving things through. This is a number of cases decided, ranked from highest to lowest. And by looking at the details, you can get in to see, okay, these are the number of units that are being produced, by each of the elements, and you can drive in and guide that. One of our clients not on the discussion today uses this to really rank and expect what the underwriters in particular are doing to make sure that the throughput is acceptable. So with that, kind of going to go back and talk a little bit about not giving profits back earned in 2020, 2021. And this is kind of an open discussion for Bob and David, knowing about the pipeline closing forecast, making sure that you're adequately provisioned with respect to production levels, trading up, and even talking about making sure that loans that have been sold, finding that data that in the heat of the battle of 2021, maybe we didn't necessarily scrub things as carefully as we can, but we do have an opportunity, in a rising real estate market, to maybe scrub those files. So this is an open forum where Bob, David, pick your topic and give us your insights.
I'll start off, Jim. I think a lot about the things that I control. And we'd like to think we control a lot of the different dynamics that impact our business. But the truth of the matter is we really don't. The market dictates a lot of those metrics, whether it be volume or interest rates or consumer sentiment, these type things. And so what I like to focus on is the things that I can control and the things that I can make a difference and impact through leadership and our team's focus. And I really think that all of these things play, a pivotal role in how you staff. Obviously, for the environment we're coming into, it's pretty amazing. The shift that we're experiencing in the first quarter. It's pretty real. I mean, we went from the absolute best environment, like I said earlier, to a new environment, and everybody's looking around saying, "Wow, we were moving so fast." And so I think really now the key is, well, how do we lessen our cures? How do we make sure that we add, we're recruiting, we're bringing in new, good quality producing loan officers. These are the things that I can impact and our team can impact. And then ultimately, at the end of the day, something I'm very focused on is that risk aspect, which even though the market's changed, I'm not going to chase my credit down. I want to be with the market on credit policy, but I don't want to take unnecessary risk that ultimately exposes the bank to greater impacts later that, it's just short-term gain, long-term pain. And so we just want to continue to play the game that we've always played, which is, quality people, process, and focus on the granular details. So I think all these things matter more than ever. And I think that adding in technology is something that we've been, greatly focused on for a while now, but really trying to take it to the next level so that we remain relevant. I see things changing faster. And, it's not 1990, it's not 2000, it's 2022. And I think it looks a lot different with the people cost associated with our business, the people that can figure out how to cut costs, which 66% of our cost in the industry is people. How do we start to whittle away at that is really what I'm focused on. Not by just listening to people, but maybe doing more with less by layering in technology.
Awesome. Bob?
Yeah, I agree with David. We're, our focus is definitely on using technology to help us understand the production of all of our employees. We, as I said, we haven't probably done a great job of that in the past, but that is certainly where we'll be able to gain some ground in 2022 with the, adding the various technology into our organization.
Awesome. So for both of you, one of the elements that in talking to some of the people at the MBA, the number 100,000 came up. And the reason that's important is there's 100,000 employees in the business at 4 trillion. Now we're at 2.5 trillion. So what happens to a lot of the people that entered the business, or what happened to the issues that we had, as few as 6 months ago, where, we just can't get people, we're hiring people, we're throwing money at people. How do you manage the transition where 100,000 employees aren't really going to be fully necessary to run our business? And that's a tough question. So I want to get everybody warmed up before I ask the tough questions.
I would say, we may be a little bit unique in that, through 2020 and 2021, we grew, but I don't know that we added a lot of fluff. So where we sit now and again, we look at what opportunities are out there with us having 2 channels, a consumer direct channel and then a pretty vibrant referral channel, purchase channel. We don't feel that we're going to have to shred a lot of our staff. We feel we're staffed pretty appropriately. However, we certainly do feel like, the tools we've implemented in the last 8 months and our ability to really start to understand production for each of the employees will help us coach them up to a more productive level if they aren't already meeting those levels.
So what you've really focused on is productivity, and I'll just tell a quick story from a friend of mine. Jonathan Core is the retired CEO of Ellie Mae, now ICE, and Jonathan would often speak about what he called human spackle, and human spackle was a term that he described. I'm going to attribute this to Jonathan. He ascribed to the tendency of mortgage bankers in particular to look at an issue, whether it's volume or increasing volume, decreasing volume, regulatory change. It was always just throw people at it. not necessarily look at the process, not necessarily look at how are we doing things, how can we do them more efficiently. And in thinking about potential panelists for today's discussion with Lone Vision's Industry Insights, both of you are really of the camp of careful hiring prevents the need to make large workforce reductions, and that productivity is the key. Would like to just explore a little bit deeper this concept of how you really deploy your efficiencies in business model as opposed to just throwing people at today's issue. And thus, I think both of you have avoided the human spackle element. So, Dave, Bob,
Yes,
jump
I'd
in.
love to answer that. So first of all, I love periods of disruption. My partner and I have always thrived in the periods that we're headed into because we've always taken a stable approach. And that means more to the right loan officers where their companies aren't, hemorrhaging and they're trying to figure out how to stay relevant. We're just going to play our game every day, and that attracts good producers. With that being said, as we look at, ultimately how you hire great people, what we did was we were very transparent with our team during the glory days of 2020 and 2021. And we said, we're not going to overhire. We're going to make you guys work harder. And I was very fortunate to have a team that just rose higher than I could have ever imagined to do the volume that we did, work weekends, all these things. Now, had it not been for COVID, maybe they would have been at soccer practice, but our team stepped up and just owned it in every way. And that actually set us up exceptionally well for the environment we're coming in today. We really don't see any changes. We'll just hire a couple of people and just keep marching. And based on the way we built our model, everything already self-adjusted. So we didn't chase salaries. They just automatically adjusted because we had the foresight to know that we only control certain things. And so the ebbs and flows in the market will be what they are. And as long as we are relevant and make money for the organization, ultimately we get to set it up the way that we want to do it so it's profitable.
David, I think that's a very interesting comment that a stable, well thought through business model adjusts pretty easily and pretty well. So you kind of shave off the tops, you shave off the bottoms, and you have a lot more stability. And I think that comes from your bottom-up profitability approach, where you set the profit target and then build everything above the line, as opposed to some teams that set, here's our volume and we'll just figure out what's left when we're all done. Is that fair?
Yeah, absolutely. We're in the midst of launching something where our team is quite excited about. That's really special because we're kind of reinventing how you look at mortgage banking from our perspective, specifically in the people cost, to deliver real value to clients and customers and make the bank money. So we're excited, and that's what we've been focused on. We're not worried about anything. We're just doing our thing, and ultimately we're working on new projects as we work on our business to say, okay, how do we take this to the next level? Like, where's the industry heading? And if you're not including technology in that conversation, you're going to get left behind, because we're going to be able to do it better and faster and deliver better rates than consumer by the way we're structuring things. So we're quite excited about that. We would rather have a stable interest rate than these peaks and valleys, and not have great times, because it just adds so many more people to the business. To your point, we just want an environment that's kind of flatter interest rates would be great, but we're also setting up for some refinances in the future. A lot of talk about interest rates running. I think that we've overpriced this move so far. I think that we talk in rate of change terms, that things happen slowly then all at once. We just saw the all at once. And I think what's ultimately going to transpire is that we actually get a little bit of a pullback. And so we're quite optimistic about that too. I don't think you'll hear that many places, but I think the structural impacts in the economy that are about to come to the front as we kind of get off the sugar high of just inducement of federal spending and things of that nature, I think ultimately maybe this corrects a little bit, and that'll be good for us, because then we'll be able to help our customers achieve a lower interest rates. So.
David, great insights. And Bob, from our discussions yesterday, you made the comment that you see opportunity, and I would love for you to share the opportunities you see and how mortgage bankers can kind of harvest some of the opportunities that you see on the horizon.
Well, certainly in the refi area, you're always going to have folks that need cash for kids for college, divorce, credit card debt. So I don't see that space. Obviously the levels at which the volume was in 2020 and 2021 will be significantly less. But if you look back prior to those years, the levels that are being projected are fairly consistent. So from our perspective, we feel like there's a lot of opportunity there, only because we have a division that has been very successful for 20 years prior to 20 and 2021. So we feel there's a lot of opportunity there. And from our company, we are expanding our footprint. We're a Midwest company. We were in the Rust Belt. So for us to gain some share, gain some additional traction there, we're just adding states where folks are moving to, and then we can certainly use our tools that we feel we're really good at from the call center side, expand the population that we engage. So we see, from the refi side and our consumer direct side, we see opportunity there. Similar to David, we didn't, with all the volume, we didn't have to go out and acquire a lot of employees. Our employees stepped up, similar to David's organization, and worked harder. So we have an older group. We've organically developed our referral side. So we see a lot of opportunity there. We do some unique things in the marketing. From a marketing standpoint, we produce podcasts. We have a really good team that does a lot of video, and so we partner with agents and doing nice broadcast video. It could be on sale or on Facebook or just a general podcast. But we're doing a nice job. We've gotten a lot of traction over the years with partnering with the agents to be more business partners, teach them how to be entrepreneurial. So we like this, or where we bring our staff, our staff up and turn them into better we've got the call center side, and we can fast track them, maybe not fast track them, but track them through that call center, get their feet wet, and then teach them how to be really good referral loan officers. So from our standpoint, we feel like we've got a lot of opportunity in this market, even though there is the what I call the noise in the media about pullback, which is valid pullback, but from where we sit, we feel like we've got a lot of opportunity.
Awesome. Any advice to the people that are attending? Any things that have really jumped out for you that you would consider to be pretty good insights to share with fellow lenders?
So, Jim, one of the things that I always try to do is stay true to the convictions that I have. And I don't bend very often, because once you start doing that, it impacts your profitability. So I take a pretty straightforward path on my thoughts and how we have done things, which comes from, years of learning. Don't do that again. And I try to remember those things and really stay true to the model.
So I've summarized that here, and I didn't want to put words in your mouth, but it's really holding tight to the model, be proactive, not reactive.
Exactly.
Yeah, and I would concur with David there. That's we've put a lot of things in place in our organization, and it's now just execute all the items we've put in place. If we just execute, we'll be just our organization will be just fine.
Awesome. So this is a really, I think, great discussion, and I've summarized this so that those of you that want it will get a slide deck out that would include these things. And one of the elements I really appreciate from David and Bob is we didn't kind of rehearse this piece. I just said we're going to do it. Always like to throw something in that might not be expected. So there you have it for the unexpected. Getting into the credit box, one of the things that we've seen is, and again, some data from the folks at MBA as well as some of our clients are seeing some pushback from investors on repurchase requests, which is kind of odd to experience at this time. And one of the elements of that really comes around whether or not you have layered risk. And when I talk about layered risk, what I'm going to do is just kind of show you the concept of layered risk and then some of the things in data that came out of that. So layered risk would be loans that have perhaps lower credit scores, higher LTV. So I'm just going to kind of pull lower credit score, higher LTV, and higher DTI. So what this really has is the classic situation of layered risk loans. And of this particular lender, that's the 450, 500 loans that have those characteristics. And one can go through and see, where they happen to end up. You could go through and really take that information and then look at the credit metrics of these and see the elevated credit metrics, go and look at data, go through and find where loans that have layered risk criteria, which means the agencies, the correspondents are likely to be looking at them if and when they don't perform. And as things pull back, one of the ideas I got from a fellow CEO was, we're taking our staff and we're going through these layered risk loans. And we're going through and making sure that they're clean. And when this individual says clean, he doesn't mean they're perfect in terms of just the objective credit criteria. Is income calculated properly? Are the explanations in these layered risk loans there? Does the income calculation stand alone and support? And it's really almost a post QC of these loans. And what this individual is doing is finding, hey, here's some holes, and just literally updating the files and resubmitting. And if they've been sold to the agencies, just keeping the credit file. If been sold to correspondents, just doing a submission to correct it. And the idea is to make sure that loans that may have done in the heat of battle in 2021, that by focusing on layered risk, you can really just pull through that. So that's an idea. David, Bob, anything on layered risk you'd like to throw in, or anything on preventing the potential of having things come back that have been originated in the last 2-3 years?
Yeah, so something we talk about all the time, Jim, is protect the house, right? If you're on our team and you're bringing in something that's questionable, you won't be on our team for very long. And so I think the way you prevent this is on the front end, making sure you have quality loan officers, you control your underwriting, and you kind of take this quality first attitude, because this is where you give up all those gains if you're not focused on the granular details of underwriting and you don't have the right people in those places to oversee this. It's going to be problematic, especially with rising fuel costs. We've pushed DTIs as an industry for a long time, and we're seeing higher inflation, which crimps consumer spending or consumers' ability to meet certain debt obligations. So I think DTI matters going forward, and I really think that instead of being reactionary, I think being proactive and kind of keeping that cultural protect the house mandate really has served us well as we've grown over the years.
Awesome. Bob, any thoughts?
Yeah, no, David hit it on the head. I think it's a cultural aspect where protect the house. We have the same philosophy, quality all the way through, and then you shouldn't have these issues.
Awesome. So one of the things that I just wanted to share, and this is just a comment on our host today, Loan Vision. What a great opportunity in the general ledger side with Loan Vision. And one of the elements that Loan Vision and Teraverde have come together, and you're now looking at Loan Vision data directly out of the GL that's looking at the performance, either net income or the top line revenue, all coming directly out of the GL. And the partnership of Loan Vision and Coheus allows the leverage of this Loan Vision data to be able to go through and look at who the top loan officers are in terms of net income, going backward, going forward, and to be able to do some things mostly aimed at top performers and bottom performers. So when you look at the top performers and bottom performers, one of the elements that is really important, and just looking at this right-hand side, is the loan officers sorted by highest to lowest net income. And what you see here is some of these loan officers have negative net income because of draws or other reasons. Really important to manage that, because it really is a great opportunity to go through and say, if there are the top 20, top 30, top 40, you also have to really handle the people that maybe aren't going to be there and can't perform to the level that you want. So that's a short discussion from our sponsors. We've covered a lot today with Bob and David. We talked about adapting your business plan, holding your team accountable to minimum standards, ways to get the most out of your operational team and to get insights, protect the house, and a little bit of what can be done with Loan Vision and Coheus. So Carl, wanted to turn it back to you to see the questions that you'd like to pose to the group before we wrap up.
Thank you, Jim, David, Bob. Really helpful and useful information there. Thank you very much for that. Some fantastic insight. I have had a couple of questions come through kind of on the private chat, so I'll jump on those. But just as a reminder, if anyone did want to ask a question, just pop it into the Q&A. We'll go ahead and address that to the group here. But first question, it looks like it's headed for David. David, you've spoken about a number of elements. Have they really made a difference in your profitability?
Sure. So one of the exercises we've looked at by looking at the data is cost and cures. In 2022, cost and cures are spoilage. It's the things that we lose profitability as a result of not, focusing on. So we did a deep dive. We aligned our system. We looked at the normal characteristics that were causing these problems, and we went back and we communicated that to our team effectively. And we reduced cures dramatically as a result of that. So that was a big focus. So I'd say absolutely, data matters.
Data matters, and just a corollary to that, I'd like to share a story of a CEO that I had a recent conversation with. And the CEO said, we have 17% withdrawals. It's cost of doing business. And my challenge to that CEO was, is it really a cost of doing business? So using some of the credit box analytics you saw a little bit before, we went through and looked at the fallout that was withdrawn, because rejections, we're saying no. Fallout on withdrawals is the client saying no. And it was very surprising to this CEO to find that the credit box, meaning the FICO, LTV, DTI of the withdrawn loans, was a better book than loans that were actually closed. And the question then becomes, is this a cost of doing business or is this an opportunity? And if every loan really matters in the environment we're approaching, I won't disclose how this CEO actually figured a way to get of that 17% to actually convert about 60% of that 17%, or said another way, they increased their volume 60% of 17%. It's roughly 10% of fundings by going through and identifying the fallout that was most likely to be recovered. The way they're doing it is proprietary, but I would challenge the group to think about, when you look at your metrics. And Bob and David, I think, are very metric driven CEO, CFO, C-level employees or leaders. It's thinking about how to manage differently with what you have and to challenge some of the assumptions about what is possible, what is not possible. So withdrawn loans are a real opportunity if you think about them that way. So that's just a corollary to Dave. And Carl, back to you.
Yeah, a similar question, but slightly different angle for Bob. Bob, you mentioned that you use a lot of data metrics to manage your business. It's something you've really bought into over the last, I think you said eight months or so. Is it really making a difference?
I feel like it is, because we are now starting to identify execution deficiencies with our staff. So from that perspective, everything was a conversation, was more anecdotal, subjective. I felt, if managers felt what they might be experiencing, now we actually have data to back up and have a conversation with our staff. So yeah, I do believe that being more in tune with the metrics and us and creating this initiative that folks, our management level folks come to a weekly meeting with their big three metrics has changed the way they approach the management of their departments. So yeah, absolutely.
Yeah, Jim, I agree with Bob. And it comes down to not just data, but accurate data, which is why it's really great that you can pull in the accounting software as we've been able to do. So,
yeah.
Perfect. Jim, just looks like we have one more. I'm going to direct this one to you. Do you have any ROI examples you're able to share with us?
Yeah, so I think one of the elements that we really do is in looking at any product that's aimed at productivity and profitability, you've got to be able to justify it. So we've done a number of use cases for our lenders, and I won't put Bob and David on the spot, but I can just kind of reiterate a couple of cases that the deployment of the product Coheus literally pays back in a couple of months. It's up and running and operational in 48 hours from access to the data, and the price point is such that it's really monthly underneath the cost of a typical loan officer's commission. So when you go through and look at how to actually earn the ROI, it's the actionable data intelligence that comes from it. So, and I think you've got a couple of examples of that from Bob and David today, and we really appreciate that. And Carl, I know you're going to wrap up and be respectful of everybody's time, but first off, I would first like to thank Bob and David for agreeing to share a lot of their thoughts today. It's always informative to talk to visionary leaders. Second, appreciate the partnership, because the benefits to the industry of being able to look at ways to innovate and look at ways to essentially improve the performance of the industry and sharing that across there is really important. So Bob, David, thank you so much. Just a fantastic job. Certainly exceeded my expectations. Carl?
Let me echo my thanks, Jim, to you as well for kind of running this. I've very much been the pretty face on this, like I normally am, but I think it's a role I play well. So thank you for your efforts, Rob, Robert. / Bob, David, thank you so much for your insight. We are indeed, as I've already said, recording this, so we will be getting that presentation out to folks here and within the next day or so. And Jim, I think you mentioned that you're willing to share the deck as well, so we'll make sure that goes out alongside. David, Bob, Jim, anything to add before I say goodbye?
Thanks for having us.
Yeah,
good stuff.
absolutely.
Carl, again, thank you for hosting. Thank you so much for what you do for the industry, for you and Martin, and congratulations on, I think you hit a record new number of customers going live this year. And I know you're to if I didn't bring it up, you wouldn't bring it up, but I'm going to force you to say, what was that record?
We put 65 independent mortgage banks live last year with the same team that we've had the last two and a half years. So to Dave's point, not going out and going crazy, using the team better and making sure that we do the right things the right way. So yeah, it was a good year, and hopefully we can continue for many years to come.
Well, Carl, Martin, again, appreciate that. You've got a tremendous team and a tremendous offering that is very effective to the industry. So ladies and gentlemen, thank you so much. Carl, thank you.
Thank you, Jim. Thank you, folks. Have a great rest of your day, and stay safe.
All right. Cheers.
Bye-bye.
Thank you.
Bye-bye.
Thanks, everyone.